Hey guys, so today I'd like us to go over quickly about how to invest in stocks. Like it's pretty basic, but just an overview of the process that you should go through when you start considering investing into the stock market. I want to give you first a small number, okay? If you had invested only $10,000 50 years ago in the S&P 500, today it would be worth more than $1 million. Just to give you an idea of the type of return that you could expect from the stock market and investments. Now, these numbers, I don't necessarily expect them to be the same, for the future, okay? Like the performance in the past shouldn't, reflect and be expected to be the same in the future, but at least it gives you an idea of what you could expect roughly. It might be plus minus that number, but at least it gives you like a rough idea. So yeah, let's dive into it and we'll go over the few basic points that you should consider when you want to invest. So first, quickly, like the few main points that you could consider when you want to invest. So you could invest your money in the stock market in index funds, ETFs, and mutual funds. Then there's also bonds. So index funds, it's basically just a fund that follows an index, pretty straightforward. An ETF, that's very similar. It's basically trading the same as a stock. And typically also ETFs would follow some type of index. Now there's mutual funds that are managed funds, okay, and they usually have higher management expense ratio along with some extra fees. And then you have bonds, which would be like company, governments, municipalities. When they, when they want to get some money, they might get and borrow money through the form of bonds, and then you can participate and buy those bonds. One point about those in particular is like mutual funds. They do lose a bit of traction in the past few years because it's been proven time and time again that if you compare, two equivalent like a mutual fund and an index fund or an ETF that follows an index, and if you compare two of them that are, roughly tracking the same type of businesses, mutual fund typically, okay, in 90% of the cases, 90% and up, typically they underperform simply because in most cases they are not going to manage to beat the market. And even if they do, the fact that they have higher, management expense ratio as well as more extra fees here and there, typically for the investors, it doesn't end up being as good as an investment. The return will be lower than if they had invested into an ETF or an index fund instead. So then you want to decide like how much money do you want to invest. Now, if you invest in the stock market, especially, that is definitely more risky, and you do not want to invest any money that you'll need, let's say in the couple coming years, typically at least 5 years. You want to stay away from the stock market in that case. Bonds, it is arguable. Like some people, would agree that okay, you could maybe invest, especially in short-term bonds. That could still be valuable. So that will depend on the type of risk that you're willing to take. Yes, in the stock market, there's simply too much, volatility and too much risk associated with investing in the stock market for the short term. So under 5 years, like under 3 years for sure. And here's a couple examples of money that you should invest instead into high interest savings account or maybe GICs or CDs in the US, or in a money market account, and potentially some bonds, potentially, but that will depend on you. So the examples would be emergency funds, okay? That you don't want to put that into the stock market for sure. Then there's any money you'll need to pay your child's tuition, okay? Or the next money for your coming vacation that you are planning. Or also if you plan to do a down payment on a house very soon, or even, within the next few years, you don't want to put that money in the stock market because if there's a downturn in the market, well, your plan might be thrown out of the window. Now, the money that you were planning to invest, you don't have it anymore. At least, it's worth way less. So it would be a pretty bad financial decision to take that money out and buy that house with that money that lost such amount of value. So then you want to think about the asset allocation, and that, okay, we'll talk about that with the amount of money that you plan to invest and you will need for at least 5 years. Typically 10 years and up is better. Well, let's start with your age. That's a pretty common parameter that you want to consider when you come up with your asset allocation. And one trick that there is out there that you can use as either straight up or you can use just for inspiration is to take 110 and minus your age. And that should be the percentage of your portfolio that should be into stocks. So let's say I'm 28. Let's round it up to be 30. 110 minus 30, that's 80%. So it technically means that it would be smart for me to invest 80% of my portfolio into stocks, and the rest would be in bonds, typically. Again, that is more like a rule of thumb. Just to give you a rough idea, if you decide to put 100% into the stock market, I mean, you can do that. If you want 90% to be a bit more aggressive than the rule, you can. And if you want to be more conservative, do you 70 or 60? I mean, it really depends on your scenario and your personality as well. It's just a rule of thumb that you can use to give you like a rough idea. And of course, then this percentage and this asset allocation, as you go through life, if you maybe like you get kids, you get married, or you get older, get closer to retirement, you want, of course, to readjust and think about this allocation question to make sure that it still fits into your current objectives. Then you want to open an investment account, and that's typically called a brokerage account. So typically your bank will have their own brokerage accounts, but you can also have like other third parties companies. So in the US, for example, there's like M1 Finance, Webull, Robinhood. All these are potential brokerage accounts or like online broker that you can use. In Canada, there's like Wealthsimple Trade, Questrade, and a bunch of other ones. But also, as I said, like just your bank, like TD, BMO, all these guys, they also have their own brokerage account that you can use. And I would advise you to dig deep into like the benefit and, and the pros and cons of each, and make your decision on which one you want to use. I have a video that's actually analyzing between Wealthsimple Trade and Questrade, which were the two ones that I looked into using to invest, and I'll link the video up there and also down in the description. So yeah, these two identified for Canadians to be two potential brokerage accounts that make a lot of sense. But before you actually open this account, this brokerage account, and start investing, you need to ask yourself a couple questions, including the type of account that you want to invest in, or potentially the type of accounts. So there is like, for the Canadians, there would be like a TFSA or RRSP or non-registered account. In the US, it's like a 401k or Roth IRA. You want to ask yourself and go over those and ask yourself, which one should I open first, second, and so on. So if we talk for Canadian with the RRSP, so that's a retirement account. And typically with those, there will be some strict rules that you'll have to follow, and you won't be able to withdraw your money if you don't, you don't use that fund for some reason, such as retirement, or if you want to buy your first home. So if you're a first home buyer, then you can withdraw that money without any penalties. But otherwise, you will get, well, first of all, taxed, and also get some penalties. The benefit of RRSP is that any money that you invest into your RRSP will be deducted from your yearly income for that year. So it's pretty good because it's going to reduce the amount of tax that you're going to pay on that year and going to be forwarded to the future. So at the time when you withdraw that money, when you're retired, or when you're a first-time buyer, it's going to use the taxes of that time in the future and not the current one. So it's a good way to reduce the number, the amount of tax that you pay for that given year, and also save on taxes as long as you withdraw the money for qualified reasons. Otherwise, you'll get hit with your taxes, some withholding fees, and also any money that you withdraw for non-accepted reasons, you won't get back that room, that potential room that you can invest. So let's say you take back 10K from your RRSP for reasons that are not covered under the RRSP rules. then you won't be able to reinvest back this 10K. You'll lose that investment room from your RSP. Then you have TFSA, so it's called a tax-free savings account, and it's not necessarily for savings account. Okay, you can use it for anything, savings account, you could do like GICs, mutual fund, index funds, ETFs even, like pretty much everything. You can use your TFSA for that type of money placements. The benefit of TFSA is that if you want to withdraw your money at any time, you won't pay any taxes at the time of withdrawal on the gains that you made. But when you invest money, as opposed to the RSP, if you invest money in the RSP, it won't be the money that you put in is won't going to be tax deductible on that year of tax. You have non-registered account, which is basically just a regular account where any gains will be taxed. So typically you want to maximize the TFSA first, like there's no downside to do that. Then once you reach the max contribution for your TFSA, then there's the question between RSP or non-registered account. And here it will depend. Like if you plan to withdraw that some of that money for some future reason, before retirement, not for a first home buyer and any other reason where you could potentially withdraw that money, then you would want to put that money into the non-registered account so you don't get hit with, extra fees and other downside that there is to take money out of the RSP for non-qualified reasons. But yeah, if you don't plan to touch the money at all until you're first home buyer or you retire, then RSP is a very good place to put your money in after you invested from in your TFSA. So that was like deciding which account to open first and which account do you want to put your money in. But then there's another point that is so that close up this point that is called asset location. And then you need to decide each securities that you have, which account do you want to put it in. Okay, because let's say a dividend paying stocks or like a bond that actually is paying some income, then you might want this into your TFSA so that you won't pay any taxes every time you get interests and dividend paid to you. But on the other side, let's say you have some growth stocks, okay? Most of the return on growth stock will be due to the increase in the worth of the price of the stock, okay? So it would be like capital gains. And typically you can invest in your TFSA as well, okay, if you have room for that. But otherwise, if you only have capital gains, you could consider putting it into a non-registered account and not touching it, okay? You don't touch it, or in your RSP, you don't touch it. The benefit is that when you will touch it, which hopefully will be in the future, maybe when you are retired, at that time, you are going to pay taxes on the capital gain. So this, for example, is just an example to show you. Then you have all this thinking to be had to decide each assets that you have, in which account does it best fit and makes the most financial sense. And that's something else that you'll need to consider. And then the next point would be to choose your stocks. Like where do you invest? Like how do you know that? So today we're not going to go over in detail like how you choose stocks and all that, but it will just give you a rough idea of things to consider. So first of all, we want to make sure that you diversify your portfolio. Okay, so you just want to invest in different type of companies, different type of industries, just to be covered and not be affected by non-systemic risks, basically. You just want to be sure that it's diversified enough. So yeah, typically you want to get into businesses and industries that you have a good understanding about, and ideally you have some competitive edge compared to other people, like you know more than these other people. That's the best way for you to have maximum return. Then you want to learn the basics of, how to analyze stocks. That would be analyzing fundamentals, the financials. And I would say that if and only if you have a good understanding of those fundamentals and financials and how to approach in selecting individual stocks, only then should you start investing into individual stocks. Also, you need to consider that it takes more time, like to invest in individual stock, and it will take more time when you select them, but also in the future, like regularly you'll need to be on top of those stocks, make sure that, that company is still doing well. So if, investing and spending time into, thinking about investing is not something that you are really into, then you can look into either mutual funds, even though, as I said, we don't like those too much, compared to ETFs or index funds. Like these, it's much easier and it's less work to invest into those. So that's something you could look into. And then the final point for today is then you want to continue investing, over time. It's not a one-time thing where you put some money and then you forget about it. You want to continue, as I said, continue analyzing your stocks, the different markets, the market in general, the overall economy, and continue being active in your management, because the more like surefire way to get successful into investing is to, if you do individual stocks, is to select good companies. Okay, select them, buy them, and then hold for the long term until you either need to sell, or if your analyzation shows that maybe that stock is not as interesting as it used to be, so then you could sell, but you need to be on top of your game here. And again, the alternative way is to just invest into like ETFs or index funds, and this would be like more long term. You don't have as much management to be had. You just need to make sure that this index still matches your investment objective, and you can still put some money regularly and invest more over time. So that was a pretty quick video on like roughly, the main points into investing. I hope it was helpful and sparked some ideas and questions. If there's any that you can't find an answer to, please put them down below and I'll make sure to get back to you and maybe make a video on that subject. If you liked it, please leave a like and subscribe, and I'll see you in the next one, guys. Okay? Have a good one.